holders and investors and market participants would be looking out for at the 41st AGM.
All right, Sajid, thanks a lot for that. And of course, we will trust you to be there and give us ball-by-ball commentary. The speech starts at 11 a.m. The usual disclaimer, Reliance Industries owns the two companies, Network 18 and TV 18, which operate the channel that you are watching, CNBC TV 18. All right, now for other stocks that we will watch. Sonia, once again, you're watching Tata Motors?
Well, the May retail sales came out overnight, and they were quite weak. So just to reiterate the fact that,
more problems.
The market is pricing in a reality which is slowdown in luxury car sales in China, and that's what you saw. So total sales down more than 2%. Jaguar sales were down 13%. And although the Land Rover sales were flat, the Evoque sales were down about 17% because of a slowdown in China. That's very interesting what's happening in the Chinese market. The Evoque is now locally produced rather than being fully imported, so it's cheaper. But the Chinese consumer is not happy with the cheaper product, thinking that it's inferior. So that's why they need to sort of change their pricing strategy, and perhaps make it a little more expensive.
That's the nano effect. I mean, people didn't buy because you didn't want to be seen in a cheap car.
Yeah.
All right. Now to get to the other company that will be on Pragya's radar, Rel Infra.
Well, some positive on the company. They've been able to refinance their project borrowings for the Mumbai Metro project. Almost about 1,650 crores was due in terms of loan repayment in 2015. Now the tenure has been extended by almost 22 years to about 2037. So that's a positive. Not just this, the company's been able to rework the interest outgo in terms of percentage also. So that's come down from 13% down to about 11.75%. The average maturity of the loans has also doubled to about 14 years. Now, remember, this project is in an SPV. Currently, it is still making losses as far as Reliance Infra is concerned. The company has just completed the first year of operations on the June 8th this year. There's a long way to go for them for this project to break even. For FY15, the revenues from this project were about 1,400 crores, but the losses were pretty massive, 200 crores approximately. So, some benefit will...
What do you mean?
No, 200 crores.
Yeah, but you said the revenues were 1,400. Okay.
Were 1,400 crores.
All right, sorry.
Yeah. So the blended effect of how this will trickle down on the bottom line will be minimal, at least at this point of time, is what the analysts are saying. Therefore, no meaningful impact, at least as far as bottom line is concerned. But any interest relief that is coming for some of these infra companies, like we saw in the case of Tata Power because of the 525 scheme, because of this what Reliance Infra is doing, it's at least a sign of a slight bit of a positivity that's coming on the interest cost, which has been a huge challenge for the last 2 years.
All right, thanks for that, Pragya. Rima, you watching Mastek today, quite obviously.
Yes, Lata, Mastek will be trading X of Majesco. So just to remind and give our viewers some basic understanding, the listed company Mastek decided to demerge its business into services as well as insurance. So services is what will be known as Mastek Limited, which will be trading today. And insurance from here on will be called as Majesco, which will be listed in about 45 to 50 days from now. Now, the street expectations for Mastek, which is your services business, in FY17, they're likely to deliver an EPS of 20 to 21 rupees per share. Now, if you assign a PE multiple of about 9 to 10 rupees per share, which is what you typically assign, for mid-tier IT companies, you do get a fair value of close to about 180 rupees per share. So this is seen as the fair value. So we're not sure whether it's going to be listed at that, but this is the fair value which is assigned by the various analysts. Now, the street is more excited about Majesco, which is the insurance business, which is not going to be trading today, rather than the Mastek, services business. And the key reason for that is that while the services business does contribute close to about 50% of the consolidated revenues, it is a more commoditized business. The main business of services is your application development and maintenance, which is where most of the IT companies have spoken about pricing pressure as well. And this company, Mastek service business, has seen some, pressure and challenges in the last few years. So earlier it used to contribute about 60% to their revenues. That has steadily come down to close to about 50%. Right now, even if you see it, the margins of services are definitely higher than insurance. Services business will have margins of about 11% versus insurance margins of only 2%. But despite that, the street is still more positive about the insurance business, because they highlight how the insurance business margins are low because the company is only making investments in it. If you strip out the investments that the company is making, their margins would be actually closer to 15%, and the gross margins are in excess of close to about 40%. So right now we will be having the services business, which will be listed today. It's your typical IT company, will be providing software services, and the fair value could be seen at closer to 180 rupees per share, going by analyst expectations. So let's see what happens today.
Rima, when you say insurance business, you mean it's a products business which is bought by insurance companies?
You know, they actually provide a lot of services to the insurance business as well. So 70% of their revenues come from providing services to the insurance business. But they also license out a lot of, revenue. So that is where the big kicker comes in. On services, you get your typical margins. But on licenses, you get, much higher margins. And going forward, the reason the street is so positive on, insurance is because they expect that the company can start increasing the licensing revenue, to these insurance companies.
Nata, I want to just make a very technical point because that is very important. It happened in Adani Enterprise case also. If you just see the stock price, it's 440 rupees. It may not happen like Adani Enterprise that the stock opens down at that 180 or 200 rupees. It may happen like Adani Enterprise as per the norms. It may fall by 10% and then the next tick could be 20%. And as the norms say, in 2 minutes, 3 minutes, it goes down by another 5% till it settles down at the fair value. Okay. There were many investors, retail investors who actually bought Adani Enterprise earlier when this adjustment was happening under the scheme of arrangement.
Not realizing that it is on its way down.
The stock was down 20% and they bought in shares, not realizing that it's an adjustment which is happening in. So, the fall on Mastech, or technical fall on Mastech could be as high as 50-60%, but it may not happen instantaneously at 9:15. So it may happen 10%, 20%, 5% going ahead and then settle down. So, the retail investor should be very careful on this regard because we heard a lot of resentment, coming from a lot of retail investors in Adani Enterprise case, which should not be repeated on Mastech.
Exactly. And I think the exchanges should have a different way of even delisting a demerged entity like this as in Adani's case. I mean, this is most welcome advice. Thank you very much, Varinder.
Also, the fair value, I think, is around 200 or so.
Yeah, 180
so
is
you will see a 50-60% fall easily. It may not happen instantaneously in 9:15. The norms exchange say 10%, 20%, then 5% gradual, downtick.
All right. So just watch out for that stock today. But Ekta is also with us. She'll tell us why she's looking at Novartis this morning. Ekta.
Yes. Well, yesterday it was in news on reports or via agency reports indicating that Novartis said to be exploring the delisting of its India unit. But we had clarifications which came in at around 5:30 p.m. in the evening when Novartis India said that they have not received any notice from Novartis AG on their plan to delist. So I expect the stock to possibly come off a little bit in today's trading session simply because of the clarification that's come in. Just to put some stats forward, it has a market cap of 2,680 crores. It touched its 52-week high in yesterday's trading session and it has sales of around 873 crores recorded in FY15 with a profit of 79 crores.
Okay. Back to you, Pragya. GMR, there were some changes in the way they will charge the fee in their airports.
That's right, Lata, and bear with me, it's a little technical as well, so I'll take a little time on this. The Ministry of Civil Aviation has now directed the Airport Economic Regulatory Authority, or popularly called the ARIA, to adopt a hybrid till model with a 30% cross-subsidization, which GMR can now use for tariff determination at the GMR Hyderabad International Airport. Now, to give a background on this, in February 2014, ARIA had decided to follow a single till model for tariff determination starting from the 1st of April 2015, because of which, of course, the entire financials and the revenue and the profitability which GMR was making on the Hyderabad airport had completely gone for a toss. The company had to obviously stop the collection of the user development fee because under the single till model, you do not, account for any kind of user development fee or passenger service fee, etc., in terms of determining your overall profit. And because of that, if you take a look at what happened to GMR's financials, and I'm talking about Hyderabad Airport's financials, for FY14, the company made a revenue of 420 crore on this, which came down to about 80 crores for FY15. They were making a profit of close to about 60 crores on this for FY14, which came down all the way to about a loss of about 190 crores because of this. Now, GMR was contesting this decision in the High Court of Andhra Pradesh. The High Court had asked the ministry to take a decision, and this, what has happened yesterday, is actually a fallout of that. Because of this, you expect to see some recovery in the airport revenue and the profitability, which had taken a big knock, as I just explained. And of course, brokerages are seeing this as a slight bit of a positive. As far as single till model goes, if you typically incur a capex, it's ARIA that decides what is the kind of revenue that as an airport developer I should be earning on a particular airport. But in determination of that, I cannot be charging any kind of user development fee or airport service fee or any kind of those things. In the hybrid till model, and remember this has a cross subsidization element to it as well, the company in the determination of the top line can include any kind of non-aero revenues, which actually come from duty-free shops, etc., those kind of things. So, a lot of the people felt that GMR was making abnormal profits from those duty-free sales and actually, were charging unfairly a user development fee as well. Because of this, this was scrapped. Now, assuming I'm making, say, about 1,000 crores of top line, and the non-aero revenues from duty-free shops, etc., stand at roughly about, say, 600 crores. Because of 30% cross-subsidization, in my top line determination, I will only be able to charge 180 crores. The balance 820 crores is what I'll charge from the passengers, because of which, I'll be able to charge a user development fee. Because of all of this, on the bottom line, it has a positive impact on the overall. The good thing is it takes away the ambiguity which the different models are being followed across India on airports. So that ambiguity sort of goes away, because this will set a sort of a precedent, which is why Edelweiss believes, that this is a good move that has come in for the company. But remember, the company has a debt of about 50,000 crores. This is a small project for them, about 3,000 crores. So the material impact on the EPS could be just about ₹1 per share.
I think it's easier to fly planes than understand this.
All right, let's do a quick recap then of our top 10 stocks today. Bank Nifty, SBI, ICICI Bank, Canara Bank, Apollo Tyres, Idea Cellular, Reliance Industries, HUL, HDFC and Ambuja Cement. That's not all. We're also tracking Tata Motors, Reliance Infra, Mastech, Novartis, and how can we forget GMR Infra as well.